After the end of World War I, the United States began a period of rapid economic growth, which was called the Roaring Twenties. So what went wrong then? There are several reasons for this. The first reason, abuse of call loans. If a person wanted to invest money in the stock market, he turned to a broker who had the appropriate license, a place on the exchange, and could buy shares for him. And in order to interest a potential investor, brokers offered the following service. If you want to buy a share, you don't have to pay the full amount. You can give us 30 to 40% of the value of this share, and we will cover the remaining 60-70% with our own funds. In fact, the broker did not have his own funds, and they borrowed this money from banks, somewhere at 6-7%. And then they lent it to the investor at 10-11%. In this way, they made money not only on commissions, but also on the difference in interest rates. For the broker himself, this scheme was considered almost risk-free, since the client's money served as a kind of guarantee. And if the price of the stock went the other way, the broker forcibly closed the client's position and sold the shares. Of course, banks also understood this, so they gladly credited these brokers instead of issuing loans to real businesses. Frankly speaking, the problem was not in the call loans themselves. Brokers had been using them for many years. The problem was in their abuse. Because the more the excitement around the shares grew, the more people wanted to buy them. To understand the scale of this excitement, it must be said that in the early 20s, the total volume of such loans fluctuated within $1 to $1.5 billion. Already in 1927, it grew to $2.5 billion, and in 1928, the amount increased from $4 billion at the beginning of the year to $6 billion at the end of the year. And these are only official data, because in addition, the excitement provoked the emergence of an unregulated market for financing brokerage operations. And these financial institutions financed brokers who serviced high-risk operations with a smaller margin from the client, earning at higher interest rates. If traditional brokers took 30% of the cost of shares, then these could take only 10% from the client. To understand the scale of this market, the following figures can be cited. The share of call loans outside the regulation of the Fed in 1929 reached 58%. In general, it was a period when even large private companies suspended investments in their own activities in order to invest money in the stock market. Because when you buy General Motors shares for $150, because you know for sure that tomorrow they will cost $200, of course it all looks like a good investment. And high interest rates on call loans do not scare you, because you know that stock prices are growing faster than interest on loans is falling. The only thing is that no one knew how long this would last, so everyone hoped to grab their jackpot while there was such an opportunity. The second reason for the crisis was such a financial innovation as an investment trust. In fact, these investment trusts were somewhat similar to modern mutual investment funds. Officially, it was believed that such trusts were created by professional investors to help people without experience invest their money correctly. And any person without experience could buy shares of this trust, and then professional trust managers invested this money in shares. As a rule, the trust did not disclose the nature of its investments even to its own investors, and people trusted them only because they were created by famous bankers and investors. The problem was that often trusts bought shares not of real companies, but of other trusts, thus creating a fictitious accumulation of assets. For example, the now famous bank Goldman Sachs, which was not a bank at that time, but was engaged in financial brokerage activities, in 1928 created the Goldman Sachs Trading Corporation Trust. Initially, this trust issued 1 million shares at a nominal value of the $100, which were immediately bought by the parent company, and then it began to sell them. At first for $104, then the price rose to $130, and later it rose to $220, only against the background of the upcoming merger with another trust. Later, the owners of the trust created another trust, Shenandoah, whose shares were bought by the previous trust. And later, the owners founded another trust, Blue Ridge. To understand the scale of these trusts, if the average size of the issue of shares of new companies was 500 million, then in 1929, these trusts issued shares for $5 billion. However, after the market crashed, it was the shares of these trusts that suffered the most. The shares of the aforementioned Goldman Sachs Trust depreciated to 1, which meant an almost complete loss of value. The third reason was the inaction of the Federal Reserve System. Did the Fed leaders see all these abuses and unhealthy excitement? Yes, but the problem was that none of them had the courage to stop this madness. And that professional participants, bankers, reputable economists and investors, at any hint of increased regulation responded with harsh criticism not to interfere in the work of the market. Therefore, none of the managers wanted to draw fire on themselves, especially since an inflated balloon cannot be punctured so that it does not burst. On the other hand, the Fed could have introduced strict regulation, but it did not do so then. The fourth reason was the unscrupulous behavior of bankers and market participants. And when the market began to collapse, some, having insider information in their hands, began to specifically play for a decline in order to make money on it. And here the story of Albert Henry Wiggin is very indicative. This man earned the title of the most popular banker on Wall Street. In 1904, he became the youngest vice president of Chase National Bank, and in 1911, he became its president. During his management, the bank's assets grew from $90 million in 1910 to $2 billion in 1930. If it were not for his greed, he could have gone down in history as one of the best bankers of his time. However, he went down in history in a completely different role. Outwardly calm and businesslike, Wiggin was an avid gambler. In the mid-20s, he created the Shermar Corporation through fake accounts. In 1929, using the accounts of his shell company, he opened a short position on 42,000 shares of his own bank, which he then closed with a profit of $4 million. A short position is the sale of shares borrowed from the owner of these shares, in order to buy these shares later at lower prices, give them to the owner, and of course keep the profit for himself. That is, as the president of the bank, he gave the bank shares to his shell company in order to make money on the decline. And this happened at a time when for the whole world he was trying to look like a good guy who was worried about the future of the bank. On Black Thursday, he and other bankers officially allocated a significant amount of money to buy into the company's shares and thus demonstrate confidence in the collapsing market, and he was even called a hero for this. And at the same time, secretly, he continued to play bearish against his own bank. The most interesting thing here is that the bank had its own amount of money to support the stock prices. Given that Wiggin knew when and in what volume and at what price the bank would place orders, he used this time to open and close positions. So you understand, it was the time of the collapse. There were many sellers in the market and very few buyers. Therefore, information about who, how much, and when was going to buy was extremely important. Also, do you think Wiggin worked with his own money? Of course not. He speculated with the bank's money. The bank generously lent money to his corporation, which Wiggin immediately used to speculate against his own bank. All of these details were later revealed during the Senate Banking Committee's investigation into the causes of the 1929 crash. The investigations revealed the extensive fraud by Wiggin and others, which eventually led to the creation of a series of laws such as Glass-Steagall of 1933, the Securities Act of 1933, and the Securities Exchange Act of 1934. The Securities Act even included Section 16, known as the Anti-Wiggin Proposal, which prohibited insider trading by company officials.